Welcome back to the Tuesday Target Audio Companion. I'm Constantine.
And I'm Penelope. This week's letter from Juri is called The Elasticity of Panic. And honestly, Constantine, it's one of the sharper takes I've read on the Hormuz situation.
Same. So let's set it up. The crowd has been screaming about two shortages all year, oil and jobs because of AI. Yuri's whole point is that both panics share the same blind spot.
Which is what?
They assume systems just sit still while shocks hit them. They don't. Systems adapt. Fast.
Take oil. Hormuz tightens up, prices spike, everyone screams 1973. And what actually happens? The UAE quietly slips out of OPEC's grip. Saudi pipelines reroute barrels straight to the Red Sea. American crude keeps flowing.
Roughly 80% of the disrupted volume already found another route. And here's the kicker. The futures curve itself is in steep backwardation. Translation, the market is literally pricing the squeeze as temporary.
While the headlines price it as permanent. That gap is the trade.
Now flip it to AI. Every quarter we get the same story. Robots are coming for your job. Meanwhile, hiring in software, engineering, accounting, customer service, all rising.
Jevons Paradox. When something gets cheaper to do, we do more of it, not less.
Yuri's line in the letter. Every time the crowd screams shortage, ask what the elastic system on the other side is already quietly building. That's the whole frame.
Beautiful. Okay, let's run through what's cooking under the hood.
Hormuz got worse over the weekend. Project Freedom, the U.S. plan to escort ships through the strait, promised safe passage. Within hours, missiles hit Fujairah, drones probed the UAE, a South Korean cargo ship took fire.
Iran said it had no plan to target Abu Dhabi, then promised lessons the Emiratis will never forget. So, mixed messaging.
Bond market noticed. The 30-year cracked 5% again, highest print since last July. Rate hike odds for next year jumped to about 80%.
That's a complete reversal of the rate cut story we walked into 2026 with. And bond volatility is whispering something equities still haven't heard.
Korea, quick one. The Korean index up 170% in 12 months, trading 50% above its 200-day moving average. Call option interest exploding.
That's not investing anymore. That's a textbook late-stage mania chart.
Korea is now a bigger equity market than the UK. Lapped Britain in 18 months.
Beautiful, parabolic, and the kind of chart that ends with a sound.
Defense Tech Corner. Eric Schmidt's Project Eagle just shipped over 10,000 MIROPS drone interceptors to U.S. troops in the Middle East. $15,000 drones knocking down million-dollar Iranian threats.
Silicon Valley spent 20 years optimizing advertising clicks. Now it's building kill chains. Capital is flooding into rare earths, robotics, satellites, counter-drone systems.
The boring industrial complex is becoming the growth story of the decade.
Okay, the week ahead. Wednesday is the quarterly refunding announcement. Watch for the words "at least" disappearing from coupon guidance. That would signal bigger auctions coming sooner.
Friday delivers non-farm payrolls. A hot print slams the door on rate cuts and cracks the long bond. AMD leads earnings with Pfizer, PayPal, Shopify, and HSBC behind it.
Tactics for this tape. Systematic buying is exhausted. Market breadth is collapsing. Holding unhedged longs into this is asking for pain.
Yuri's framework. Defined risk volatility structures. Index put debit spreads. VIX call debit spreads. Hedge cheaply. Keep your upside.
Pair it with hard assets and energy security plays. Avoid the crowded, over-leveraged tech consensus.
And the trade of the week, JetBlue. Ticker JBLU.
This one's clever. Bureaucrats blocked the JetBlue Spirit merger. Spirit went bankrupt and liquidated anyway. Now JetBlue absorbs Spirit's South Florida routes, outsized market share, real pricing power, without writing a single M&A check.
Yuri's targeting 255 days to expiration. Aggressive out-of-the-money debit call spread. Highly leveraged upside, strictly defined risk.
One caveat, elevated Brent is a fuel cost overhang. Size accordingly. And as always, this is food for thought, not an official trade entry. Those go in the trade alerts section.
That's it for this week. The frame to carry with you. When the crowd panics about shortage, look at what the elastic system on the other side is quietly building.
Trade smart, stay hedged. We'll see you next Tuesday.